ahead of the midweek trade. Mark, good morning, and how's it looking over there?
Hey, good morning, John. You know, we started out a little bit quiet here on Wall Street this morning, but then the S&P futures, they dipped recently in like the last 5 minutes, about 10% of a point. So that's where we are right now. Here at the CBOE Chicago, the VIX is around 15.7, up slightly this morning, but that still puts volatility in a relatively calm range and well below that 20 level we typically associate with more fear and stress in the market. And small caps are also pretty quiet this morning, with Russell 2000 futures hovering around the flat line. Investors are also watching tech today that you mentioned, with Nvidia and Salesforce both reporting after the closing bell. Both can move the tech sector, and Nvidia is big enough that a significant move there can also have an impact on the broader market. So right now, a fairly quiet start as we head toward the open.
All right, Mark, so it's also a huge morning for breaking data. So how are CBOE traders digesting the latest inflation and GDP data?
Yeah, a lot of data came out just recently, and the numbers are kind of all over the place, but the market reaction has been pretty quiet so far. The GDP, measuring how fast the economy is growing, came in at an annual rate of 1.5% in the second quarter. That was unchanged from the initial estimate and down from 2.1% growth in the first quarter. PCE, the Fed's preferred measure on inflation, headline PCE came in at 3.7% from a year ago. Core PCE, which takes out food and energy, came in at 3.3%, and both headline and core PCE rose 0.2% from June. The takeaway here is that inflation is still running above the Fed's 2% target, but we did not get a major surprise this morning, and that may help explain why we're not seeing a big reaction across the board with stock futures or the VIX. For traders, it really comes back to the Fed and the interest rates. The economy is still growing, but at a slower pace while inflation remains sticky. So these numbers don't necessarily make the Fed's next move any easier.
All right, Mark, well, thank you so much for that update. Of course, we'll catch you back here later today on Market Movers Midday to talk about NVIDIA earnings. See you then.
See you this afternoon.
Coming up next, New York Stock Exchange floor trader Tim Anderson tells us what this morning's PCE and GDP data mean for the markets.
All right, welcome back. So let's get to the big story breakdown. We continue to trek along in this busy week, last full trading week of August. Now, this morning we received the Fed's preferred inflation gauge ahead of Kevin Warsh's Jackson Hole speech on Friday. Now, after the close, all eyes will be on NVIDIA's Q2 earnings amid the AI financing rush, underlying industry concerns over CapEx. So a lot to discuss. So joining me to break all this down is Tim Anderson, Managing Director of TJM Investments. Tim, thank you so much for being with us. How are you today?
Johnny, it's great to be with you today. It's kind of a little bit like the calm before the storm. The market's just been in a churn really for the last 4 or 5 days, but I'm sure there's plenty of action to come in the next couple of days.
Well, like you said, the calm before the storm, that's the perfect way to say it. So let's start off with this morning's breaking data. Chair Warsh said that he is taking an expanded view of inflation behind PCE, and through all that, he's saying that the Fed's preferred inflation measure still stands out. So when you hear all that, what actually stands out to you about the data that we received today?
You know, it's pretty much unch from last month. I realized that the headline number was up 1/10, and people were expecting it to be unchanged. The core number was unchanged on a year-to-year basis. The Dow futures did sell off a little bit on it. Some of the headlines are that the number was hot, but I think that's really stretching to look at some impact behind what was really a pretty benign report, with oil still right around in the 90s, high 80s, low 90s to mid 90s, and gasoline above $4 for inflation to be unch from last month is almost a little bit encouraging. And I think it'll be interesting to see what Chairman Warsh has to say about that and a number of other topics on Friday.
All right, so Tim, like you said, the calm before the storm. Today's going to be a big day. Tomorrow's going to be a big day. Friday, a huge day, because we're going to hear from the Jackson Hole press conference on Friday. We're going to hear more about what Warsh has to say on Friday. So what do you expect the market reaction to be after this press conference?
You know, it's a great question, because the best debate that I've heard this week has been who's going to have more of an impact on the market going into for the rest of the year, really. Is it going to be Jensen Huang when he talks at the NVIDIA earnings conference after their earnings report later this afternoon? Or is it going to be Kevin Warsh on Friday morning? So, look, I think Kevin Warsh is not going to really give a lot of information that people really want. He's stated he's going to tail back on giving forward guidance. But I think the theme of this conference is the impact of technology on the economy, blah, 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 blah. Okay, so I think he's going to talk about productivity, because he's mentioned it in the past. And he's been very clear that if this AI revolution produces a strong uptrend in productivity, that would be disinflationary. And I think the last time you and I spoke, I was pretty clear that I know I'm in an extreme minority, maybe a little bit less of a minority than the last time. I don't think they're going to hike rates this year. In fact, I think their next move is going to be a cut, because I think this ramp up that we're having in productivity is going to be disinflationary, as Chairman Warsh has alluded it should be, and that's going to start to bear out in the data as we get closer to the end of the year.
All right, so definitely people are going to be watching his every word for that press conference on Friday. But I want to talk to you about the Treasury's plan now. Let's pivot a little bit.
Sure.
The Treasury's plan to buy long-term debt, the buyback situation. We've seen yields come down, but some economists are questioning if the federal government should be making moves here. Do you think that this could actually benefit the markets?
You know, I think that it's a preemptive move, and if you think back to the I believe it was the third quarter of 24 and a couple of other times in the last 6 to 8 years. In the late in the year, the market has had this little technical disruption where they get a little frozen, liquidity gets a little stuck on a couple of occasions. There's been some issues in the repo market, and I think what Bessent is trying to do is stay one step ahead of that and prevent that from happening this year. And this is really very much just a technical move. You're not real as much as it sounds like a big number. It's not really a lot in terms of what they're buying, and they're buying things that have definitely lower liquidity because they are off the run issues that are not really actively traded right now.
All right, so you said it best, calm before the storm, closing bell will happen, the video will report. So I want to talk a little bit about that because the stock snapped a 7-day losing streak yesterday.
Sure.
So specifically, this comes amid AI financing, the concerns over the industry CapEx numbers. What are you watching for, and how will it impact the semiconductor trade specifically?
Look, I think that the other headline that's been thrown out a lot the last couple of weeks is, and there was an article in the Wall Street Journal yesterday about NVIDIA has now become a banker to the AI world, and that there's a big risk with that if the AI trade were to come to and the AI investment cycle were to come to a screeching halt, that would be a major risk for NVIDIA. So I think he's going to get a lot of questions on that. Now, I think the probability of that happening is it's almost like, what if the sun doesn't come up tomorrow? Okay. But I think that he's going to get questions on that in the conference call, and I think that will be one of the more interesting exchanges he has with the investment and analyst community.
All right, so NVIDIA, obviously, that's a big topic, but we're also looking at other earnings such as Salesforce and Marvel Tech.
Yeah.
That's going to be coming out today and tomorrow.
Yeah.
Exactly. So let's talk about the software sector specifically. Is it trying to move past earlier AI disruption fears at this point, or how do you think the two sectors match up?
Look, the software names are up about 25% this month. Okay, so they've had a pretty good bounce off of that very depressed level that they were stuck in from February-ish, early March, when the big fears came out that AI might really make major disruptions and displacements in the software industry. I think the software stocks that are very high quality, that have a large installed base, and that have smart people running them, are going to be able to recover from that. Maybe they're not going to go back to the very high levels that they were at over the last couple of years, but I don't think these companies are going away. Okay, I think the best comment I heard months ago when everybody was concerned about the software companies going out of business was that if Anthropic really thought that they were going to put Salesforce out of business, they wouldn't be advertising on their LinkedIn page for Salesforce administrators at Anthropic. Yeah. So, look, the stocks had a violent reaction. It was a little bit of an emotional trade, and plenty of people had big profits in the sector. So now they've had 6 months or so to reflect and repair and plan for the where we go from here. And you're starting to see with ServiceNow and Snowflake and Salesforce which ones are really going to get through this and put themselves in a position for a strong 27.
It's definitely interesting to see what's going to be happening in 2027. I want to talk about the U.S. dollar because we've seen that it's weakened this month. The debasement trade is back on. So what are your thoughts on the rally that we've seen in precious metals, and is it just getting started?
I think the precious metal rally is just getting started. We had a very, very strong move early in the year. Gold was probably a little stretched out at 5,500, but it held the 4,000 level very nicely on a number of occasions, maybe 2 to 4 months ago. So, and silver, of course, had this parabolic move up above 110 that was just unsustainable. But now if you look at uranium, you look at copper, you look at gold and some other precious metals, these stocks look like they're in the beginning of a multi-year rally. I know that a lot of commodity analysts have used the term super cycle. I'll let them go there. I'm not going to go there yet. And obviously gold specifically is going to trade contra to the dollar. So if the dollar were to weaken gradually, which it has recently, that's going to help the gold trade.
All right, so one last question. We have less than a minute. Let's talk about oil specifically. U.S. and Iran still, this war impacting markets, oil prices trending in the right direction at this point. What's your thoughts?
Well, I think they're kind of at equilibrium right now.
The Groundhog's Day in a way. It's the same thing over and over, week after week. So up and down, a lot going on.
Look, if the U.S. wasn't producing as much oil as they are, oil prices would probably be 120 to 130, not 80 to 90. Yeah. So I think that when you really consider everything that's gone on with the oil production disruption from Iran and the transport of oil through the Gulf being disrupted so significantly, the fact that oil is hovering in the mid 80s, maybe low 90s, is actually remarkable.
Yeah.
So if you were to get a breakthrough finally in some resolution over there, you know, you could go back. You could be in the low to mid 70s pretty quickly, and we've seen that on a couple of occasions. You know, over the last 2 months when we thought we were on the verge of a resolution.
Possible resolution.
Yeah.
Well, you know what? It's definitely going to be interesting to see what happens in the next couple of weeks. But Tim, thank
Never
you
a
so
dull
much
moment.
for joining us. Never a dull moment. And again, the mayhem. I don't know if
Hey,
we're about to start it.
there
We're in it, so we'll see.
People used to always talk about the summer doldrums and the dog days of August.
I don't think that's happening
Not
nowadays.
this year.
And that definitely was, Tim, thanks so much for joining us.
Yeah.
Straight ahead, Rick Hara with the latest from the world of sports.
All right, so welcome back to Market Movers, the opening bell. So we are in late August, and that means that baseball's run as the only major sport in action is quickly coming to an end. Now, the college football season kicks off on Saturday, though week 0 isn't exactly the strongest slate of games. Now, meanwhile, the U.S. Open is back in town with the main draw tipping off on Sunday over in Queens. And here in New York, some optimism growing for the NFL regular season, with both the Jets and Giants securing victories in their latest preseason games. So joining me to discuss this and more is Rick Haro, FinTech TV sports business analyst. Rick, thanks so much for joining us and welcome back.
Thank you, man.
All right, Rick, so even though it's the offseason, let's start off with LeBron James. A story from Bloomberg yesterday reported that years ago, LeBron raised nearly $300 million in upfront cash by issuing private bonds through a company he controls called King James Funding. And that is a part of the underlying trend in which a lot of high net worth athletes, they structure this Wall Street style celebrity bonds to get massive liquidity early. So, Rick, let's break this down for us.
Well, it's not new, but it is not for the faint of heart. You know, Michael Jordan, Shaq, Serena, some of the highest awareness net worth individuals who are entrepreneurs as well, decided to sell their entrepreneurial spirit and basically create effectively blind trust where if you believe in their ability to make some dollars, you're going to invest. And LeBron, clearly, he's got dollars in other leagues. He's got dollars in Liverpool for soccer. He's interested in the PGA Tour. He's made some connections. And so don't bet against LeBron James. And he's going to be an amazing component to what some say will be Philadelphia 76ers title run, although I know I'm talking to somebody in New York. Don't cut me off. But at the end of the day, he'll be evaluated in the boardroom acumen, not just on the court.
Yeah, you know what, Rick? I think a lot of people have decided not to bet against LeBron. But now let's turn to the real fun, Rick, and that's college football. So the season kicks off this Saturday with week 0 action. But we're not going to lie, Rick, there's a little disappointment with the slate. So only one ranked team is in action, and that's number 14, USC. So is there anything worth tuning in for this specific week, or do we actually still have one more week to go?
Well, let's defer that question to the NFL preseason question because there's a definite answer on this one. On this one, it is interesting. Now, I went to Northwestern undergrad. Now, my math classes, I went out to Wrigley Field instead of going to the math classes, and also law school at Harvard. There is no such thing where you start with week 0. What's week 0 all about? But that is the way to standardize. And by the way, the NFL and college are giving up a couple of really interesting windows. The Sunday afternoon, Sunday evening, where the FedEx Cup final will happen by default, and Monday night. Usually you have something. This year you have nothing. I understand it's not a great week, but it will be a great season. Take a look at what the college football world has. I see that on the graphic. But $3.5 billion in merchandise bought. About 540 million households tune in a year, and 69 million people show up personally. When you think about it, these fans, by the way, are 1.6 times more likely to earn $100K than other non-avid fans. And the reason I'm saying that is you don't need a great slate to continue college football the way it looks. Now, I'm from Miami, though I didn't go there. Watch the Hurricanes again. National championship game last year, maybe this year. You didn't ask me, but I'm telling you.
All right, Rick, well, let's talk a little bit more about the NFL. So we all have that one player from our favorite team that skipped senior year and went over to the NFL. But having them come back, if that didn't work out, always seemed like a pipe dream. So that's obviously what we're seeing this week with Cleveland Browns tight end Daquan Wright entered the college transfer portal. So as expected to join the LSU Tigers. So this caused the Big Ten and the SEC to pass a rule banning NFL players from going back to school to play football. So take us through this wild and interesting situation.
Well, we don't have enough time because it's antitrust issues, it's evolutionary, it's what the governance is, it's the Big Two versus all of the other conferences and what leverage they have. Suffice to say that there are enough players coming up where they want to control the ability for players who have left to come back on a free watch. So that's the theory behind it. Obviously, the schools that want those players back are going to want to create the exceptions. Free looks interesting. The leagues have a precedent too. Sign with an agent. The agent acts for you. There's a whole bunch of eliminated eligibility attached to that. This, by the way, Johnny, is a work in progress. So we'll have to see how it all shakes out.
Awesome, definitely. Thank you so much for joining us, Rick. Definitely appreciate your time and your insight on what's going on in the world of sports.
See you next week, whenever. Go Giants, go Jets. How's that?
Hey, we'll take it. Thank you so much. And ringing the opening bell here at the New York Stock Exchange is Optimex Tax Asset Management to celebrate the launch of the Optimal Tax Managed Equity ETF. And over in Chicago, as we can see, the SIBO internal floor operations team is set to ring the bell in the midweek trade. Now, here at the NYSE, the Optimal Tax Managed Equity ETF is an actively managed fund designed specifically to maximize long term. And take a look, this is the moment that we've all been waiting for, the ringing of the opening bell. All right, so that was a ringing of the opening bell in Chicago and here in New York. And to kick off the week, let's go ahead and take a look at the markets this morning. Right now, we can see the Dow, it is down in the red, down about 9 points. And now when we take a look at the NASDAQ is also in the red this morning. You can see that it is down almost 0.5%. We can see it is down about 116 points. And when we look at the S&P 500, it is down about 0.1%, give or take down about 11 points this morning. And meanwhile, the NYSE Composite Index, which tracks all the companies listed here at the exchange, is also down a little bit over 0.1%, down about 42 points this morning. And taking a look at Treasury yields, we can see that the 10-year Treasury yield has been give or take about 4.65%. And when we look at the 30-year yield, we can see that the 30-year yield is also roughly give or take at around 5.179%. And when we take a look at oil this morning, we know that there's been a lot of movement with oil in the last couple of weeks, but we know that the barrel right now is about $80.74 this morning. And when we look at Brent, we also know that there has been movement there, and the barrel this morning, right after the opening bell, is roughly over $85 at $86.69 a barrel.
Up next, the World Gold Council's Joe Cavatoni breaks down gold's monster run this month.
Welcome back to Market Movers, the opening bell. In New York morning trade, we are looking at spot gold prices moving lower but holding at around 4,600. Now the precious metal rising to its highest level in over 3 months this week, with the debasement trade seemingly back on. Now gold's renewed rally coinciding with the national debt surpassing $40 trillion, and billionaire Ray Dalio says that investors should buy gold because of the deficit. Now, joining me to discuss this and more is Joe Cavatoni, Senior Market Strategist and Head of Public Policy, U.S. World Gold Council. Joe, thanks so much for being with us. Good morning. How's it going today?
It's exciting. It's going well. Thanks for having me. I'm always excited to be back and talk about the gold market, which, contrary to popular opinion maybe 4 or 5 years ago, is probably one of the hottest markets for people to keep an eye on today.
So let's start off with that. Let's start off with this new renewed rally that we have going on. We saw spot prices drop below, I'm looking here, about 4,000 over the summer, but now we're back to 3 months high. What's the reason for this run?
So remember, we had a 162% return in gold up to January of this year. Now what we're seeing are the fundamentals that we've been talking about, keeping that gold price rising, and those floors, those new floors, that 4,000 level, the 3,500 level, 4,000 level, that's coming back to be a very, very relevant and certain topic that needs to be addressed. It's debt levels at the fundamentals for G7 nations. It's how the U.S. is going to deal with this shift in how inflation's actually developing, and more important than all, what's going to happen with fiat currencies and the debt that goes with that fiat currencies as a reserve asset.
All right, so this summer we also saw gold consolidate for a number of weeks. So what does that actually say about the technical setup for the spike that we're seeing right now?
So I think people are looking at gold in two ways. There's the momentum trade, where they look at things that are like flare-ups around conflict, war in Iran, but those things tend to push the price, then pull it back down. Where we are today is we're actually setting back into a slow, steady climb that's actually based on this whole economic condition that's basically playing out around these big countries. And this debt level you talked to, the $40 trillion, is now a big number, it's a big concern. And we're watching what Besant and Warsh are going to do on their sides of the table to manage the concerns around that. Can people buy these assets comfortably as the safe haven or the store of value that they need, and will gold fill the role as a wealth preserving asset?
So I also want to talk about Jackson Hole, because that is something that everyone is looking forward to on Friday. It's the big talk of the town. So what are you watching for from the presser that's going to be happening, and what exactly will this mean for gold?
Sure. I think what we are trying to keep our close watch on is exactly what the mechanisms will be for the control around inflation. I know everyone's wondering if rates will be hiked or cut, but you need to see a little bit more detail around whether or not that definition and the understanding of how inflation's taking place in these markets will be reassessed by the Fed, and if they will look at things slightly different than maybe we have in the past. I think that's been a big shift in what we've been hearing and seeing around the globe. We've had transitory inflationary pressures, but you have introduction of technology, you have changes in the way that people are living, debt levels, et cetera, and these are all having much more complex implications on inflation. So I want to see if I can hear more from the Fed on how they're assessing the definition of inflation, because then we'll be able to see more appropriately how they're going to look to the rate market to handle the pressures that come along with it.
So GOD is a popular gold miners ETF. So take us through the ETF inflows and what you're tracking with gold funds specifically.
So GLD, the Spider Gold shares, is just the spot price of gold. So it's actually the perfect instrument if you want to invest in gold. If you want to buy miners, there are other instruments you can buy, but this is actually the instrument of choice for people who want to have price performance of gold. And what's driving it right now? Two factors. Number one, the fundamentals continue to drive flows into ETFs. This debt question and this concern around fiat currency and debasement, as you put it, but also a little bit of momentum. People are anticipating what happened with the bond market on Monday, what's happening this week with the Fed in Jackson Hole, and then the September FOMC meeting. So they're kind of getting ahead of it. So we see a little bit of that momentum pushing the price up too. You can see that as well in options and those derivatives that are linked to speculation and calls on the bull market, in particular in GLD.
All right, so I want to get your input regarding structural themes behind this specific rally that's going on.
The biggest theme I think people need to remind themselves of is when a central bank looks at its reserve portfolios on a global basis, particularly the 70 some odd that we survey on an annual basis, They see a need for wealth preservation, asset preservation, liquidity. They're continuing to allocate to gold. So that's a big structural shift that we've had that we're not going to see that slow down anytime soon. And then secondly, I think again, wealth preservation. So people often talk of gold as a safe haven or where you go when you're worried. Wealth preservation is actually the big key message we get to people. I want to hold on to my assets. I need a liquid asset that I could sell when risk assets are selling off. That's where I think gold's role in the portfolio is increasing to shift. And that's why we've seen that steady climb in the gold ETF flows among certain instruments, but the speculative flows are also weighing in. I think keep an eye on wealth preservation and real assets, how they fit into portfolios.
So I want to talk to you about your outlook for the next couple of months. What is your thoughts on the outlook for the precious metal?
Three things I think are key to watch. Number one, keep an eye on how fiat currencies perform because that'll have impact on the gold market. Second, I think keep an eye on the big trends that we've just talked to, in particular central banks. And then third, expect higher levels of volatility. Gold's a huge market globally. It can be speculated. It's the largest with oil amongst commodity markets. So you've got a lot of players that are going to push the market around, pull it back and forth. So don't get worried about the increased levels of volatility. Just understand that structural shift is going to keep the market moving forward.
All right, and even though it's a recession hedge, could gold coexist with record high equities? And if so, what assets are gold's biggest rivals right now? I mean, there's a lot going on. So.
There are a lot of things going on. So can it perform when markets perform well? Yes, because wealth creation continues to contribute to gold's performance. You might see an increase in jewelry and consumable assets continuing to play a role in the gold market if that is the shift that we see on a global basis. And can it play a role with the competitive landscape? Right now, rates, higher rates, deposits, short-term yields might be attractive to people on the shorter term, but the credit risk that comes along with those instruments is what keeps gold adding into the portfolio element. And I think wealth preservation is the shift mindset that we have, not just safe haven worries about a market crash, wealth preservation, because that steady climb up with that structural shift keeps gold moving in the right direction.
Awesome, Joe. Well, definitely interesting to see how gold progresses and see what's going to happen in the future. But thank you so much for joining us. A pleasure to have you here.
Great to be here. Thank you.
Thank you.
Coming up today on Market Movers Midday, stock market insights from Entry Point Wealth Management's Chris Ward, and a breakdown of crypto's August rally from analyst Ray Salma.
As of August 3rd, Plus Therapeutics officially named Cerenome. The rebrand reflects a bigger evolution from a therapeutics company into an integrated CNS oncology company focused on cancers of the brain and central nervous system. Cerenome brings 3 platforms under one roof. Its CNSide diagnostic, commercially available and reimbursed, helps detect and monitor CNS cancers through spinal fluid testing. Its lead investigational therapy, Rheobic, is being studied in clinical trials designed to deliver targeted radiation directly to CNS tumors. Those trials target 3 of the highest CNS cancers: glioblastoma, leptomeningeal metastases, and pediatric brain cancer. A proprietary data and artificial intelligence platform turns complex data into insights that support precision oncology. In the company's words, CNS cancers are, quote, a systems problem requiring a comprehensive and unified approach. The name says it all: Cera for the brain and central nervous system, plus Nome for the knowledge that powers precision medicine. The stock is now trading under a new ticker, CNSY. For shareholders, no action is required. Same mission, improving outcomes for patients with CNS cancers, a new name for what comes next. Learn more at cerenome.com.
Still to come, a look at the IPO market with Click Capital Markets' Scott Coyle.
Welcome back to Market Movers, the opening bell. Not surprisingly, June's mega IPO from SpaceX drawing a record amount of activity from retail investors. They placed more than $70 billion in pre-IPO orders and bought over $405 million in net shares on the opening market during the first week of trading. And the IPO market is set to get even hotter in the fall. Anthropic could make its market debut as soon as next month, and it's eyeing for a $2 trillion valuation that surpasses SpaceX. Now, joining me to break this down is Scott Coyle, founder and CEO of Click Capital Markets. Scott, good morning, and thank you so much for being with us.
Good morning. Thanks for having me on.
All right, Scott, so take us through the current IPO environment and the increase in retail demand.
The current environment is super active. I think we're going to have a very busy next 18 months based on all the issuers we're talking to as far as some of the major underwriters. So I think it's going to be very busy. And what's happened on the retail side is there's an explosion in smartphone use in the US and globally. And every retail investor wants access. They want to buy all products from their smartphones, including IPOs. So it's much more readily available now to get access to these products than it ever has been.
All right, so I also want to talk and get your point of view on how is retail an investor base that looks and feels differently than it did historically?
Well, historically, retail and IPOs has had a bad name because many years ago, retail investors were attached to a financial advisor that would buy the IPO and be more interested in flipping it. And nowadays, more retail investors have access to, AI analytics and other things, and so they research these companies, and they tend to be more buyers and holders. And you're seeing that in like the SpaceX IPO. The buying post IPO and the holding patterns have been from retail investors, and we saw it recently on Jersey Mike's as well. Retail's been the buyer and holder of that, so it's a customer base that any issuer that's going public, if they want a global brand opportunity, giving those shares to retail investors has proven to be a very good value proposition for issuers.
Definitely. And Scott, I want to get your point of view because why do you say companies should be actively trying to appeal to retail traders specifically?
Because at the time of your IPO, you are going to be super high profile as an issuer, and now you have an opportunity to brand your business, whether it's retail or if it's an enterprise business. You can brand it at the time of your IPO globally with retail investors. And there's all kinds of studies that when somebody buys your stock, they tend to also buy your product. So it's a huge opportunity that did not exist, but because of technology, it exists today. That's why we built the Click Capital Markets platform. We have an API connected to over 100 million people in the US and globally. And it's just, you didn't have this branding opportunity as an issuer, 5 or 10 years ago. But when you go public, you do, provided you give a major portion of your IPO to retail investors.
All right, Scott, so you touched briefly on it. So I want you to give us a background on your company, Click Capital Markets, and what you guys are looking to solve.
So we formed Click Capital Markets because we felt like retail investors did not have access to many capital markets products, specifically IPOs. So we've placed over 450 offerings through our platform since inception. Probably 330 of those have been IPOs. But what we've done is we've got an API embedded technology that's connected with online broker dealers in the US and globally. And this allows sort of one pipe going into the issuer and the underwriter when a company goes public. So we're making it easier for retail investors to get access to these IPOs, these companies that are coming public.
And Scott, how does Click support, reach, and connect companies to broker deals and retail investors?
We do that through an API. So our API is embedded in over 20 broker dealers in the US and globally. We have over 100 million people on this pipe now. That number is going to be close to 300 or 400 million by the end of the year based on new integrations we're doing. So that end investor places an order, it routes from their broker dealer all the way through Click, and we aggregate those orders and we reflect those orders to the lead underwriter and the issuer. So the advantage the issuer has through Click, they can see this demand curve building very quickly. And based on that demand curve, we can even give them pricing advice and how to price it, things like that. We worked very closely with Bullish when it went public. We worked closely with Figure Markets and a number of other companies. Jersey Mike's was a recent one we worked really closely to. So we make it easier for the end investor, and we give the data and analytics that the issuer needs to make decisions on, distribution and the final price of the IPO, right? We can help them price it better than they could otherwise because we have a global look at demand versus just what they see in the institutional book.
And I also want to get your point of view. Are you in favor of expanded private market access, or is the current IPO market serving businesses and retail traders alike? What are your thoughts, Scott?
I think you're going to see expanded private market access. I mean, really what that's about is individual investors that need the growth can't get it, and everybody that already gets the growth doesn't need it, right? So individual investors want access. So I see the private market continuing to expand, but really what they're trying to do in the private markets is make it kind of like a public market. So if with many of these companies, if they think about going public sooner in the process, they've got that branding opportunity they need. Liquidity comes earlier in the process for many investors. So I see it continuing to grow, but I also see I see the rotation, the public market becoming more robust because of it, because it's just easier for the company to go public than it is. These private raises they're still a little bit clunky.
All right, and Scott, to wrap up, we have less than a minute left. So I want to get your thoughts. What do you expect to see in terms of retail activity this fall surrounding the highly anticipated IPOs coming up?
I see, huge retail interest. A number of these. I don't want to talk about any company specifically. I'm a licensed broker until that prospectus is available, we're limited on what we can really talk about. But many of these brand names that are coming, you're going to see huge retail demand. It will be massive, and retail is going to be in there at the IPO, and they're going to be huge buyers in the aftermarket. And I think the more these companies can allocate to retail at the IPO, it's going to be better for the ecosystem. It'll be better for the company long term. There's going to be a major shift in how IPOs are allocated in the future. A huge piece of it, 50% or more, is going to go to retail, in my opinion.
Awesome. Well, Scott, it's definitely going to be interesting to see what happens and how this all plays out. Again, thank you so much, Scott Coyle, founder and CEO of Click Capital Markets.
Thank you.
And coming up, a final look ahead when Market Movers comes right back. All right, nearly 30 minutes into today's trading session, and we are seeing the major averages peak out of a small gain after the July PCE. We can see that the Dow Jones, it is roughly down almost flat, roughly down about 6 points. And when we head over to the NASDAQ, we see that the NASDAQ is moving into the right direction. We know that it is up about 0.06%, about 16 points. And then when we head over to the S&P 500, we also see that the S&P 500 is heading into the green. The S&P 500 is roughly up about 8 points, give or take. And also, meanwhile, the NYSE Composite Index, which tracks all companies listed here at the exchange, we see that it is up about 22 points this morning. And of course, we will be back for Market Movers Midday live at noon Eastern time. Thank you guys so much for watching. And of course, we'll see you then. I'm Johnny Fernandez, and have a great day.